respected heads of the organizations, my esteemed friends, seniors in the profession, ladies and gentlemen. It is indeed a privilege to be here on this combined meeting, a good trend, to deal with this subject of international taxation amendments which have been made in this Finance Bill 2017, popularly called as budget. Out of these two major amendments, there are a couple of amendments which I will try to deal with the time permitted. But my whole energy should be concentrated on first two amendments, the secondary adjustments and the thin capitalization. As far as thin capitalization was concerned, it was expected this to come to the country. It was not surprising. It was not surprising that we are going to be left behind. This will not come in the country. Thin capitalization was expected. Because that was the only item left, except out of the two items left from the direct tax code which government had presented 3 times unsuccessfully. So later on they pick and choose each of the concepts and introduced in the Income Tax Act from time to time. What was left was CFC and thin capitalization. But we have seen few days before a circular was issued clarifying the concept of poem in India. Poem is the place of effective management, and all of you know how cacophony it was. And this poem, place of effective management, which was clarified through a circular, literally covers CFC. Literally. It is therefore there was no warrant to have CFC separately once you have got poem as in the name of CFC. So what is left with us? Left with the direct tax code, only thin capitalization, and they have introduced thin capitalization in this fashion in our budget this year. Please note, thin capitalization is not part of transfer pricing regulation. It is an anti-avoidance regulation under a separate section of 94B. Whereas secondary adjustment is an amendment in the series of sections dealing with transfer pricing provisions, and therefore it is related to transfer pricing. While studying these provisions, one thought came to my mind. 94% of the tax disputes on transfer pricings are decided by the ITAT, High Court, etc. in favor of the taxpayer. So only 6% cases are left to the tax department in favor. I do not know what will be their fate when it goes to higher courts further. Why do we want to tinker these provisions so quickly, so badly? I fail to understand logic behind introducing provisions. On the contrary, if we are saying that we need to have CFC in our country, poem is introduced by way of a CFC is introduced by way of a poem, transfer pricing should be done away with as far as those provisions where the poem is applied. When whole of the profit is going to be taxed of the foreign enterprise in India, how can you have further transfer pricing in relation to that company and having a transaction with India? And therefore, I believe introspection is needed. Really, we have to have thin capital. We have to have CFC or the transfer pricing provisions. One of them will survive and not both. Wherever poem is regarded as company having been resident in India, do away with the transfer pricing provisions. Second thought which came to my mind is a general appeal. Is this that we are fully developed? Do we need capital? Or we don't need a capital? If we need a capital, follow the experience of China 20 years before. Allow foreigners to come, welcome, and at least we have a good system of welcoming Atithi Devo Bhava with thali, garland, tika, everything. invite them, welcome them, ask them to bring the capital into the country as much as they can bring. What China did in 72 till 91, we opened the parcels in 91. By that time, China progressed phenomenally. Now today, getting out of China is difficult. So first of all, allow people to come. Let country develop. Let Swachh Bharat Abhiyan go on. Let Make in India concept go on, which is very important. Now the world is becoming anti-globalization forum. You have Trump, which is now creating protectionism, Brexit. Then other countries will follow America. So all protectionism will come up. In such a situation, how do you expect people, foreigners, to come and do business in your country? This was one bad move in my personal opinion, quickly. Just because you want to follow the world, you are doing something which is absolutely irrational. Reason I give you. India is growing at 7.2% growth rate. Phenomenal growth rate, number one in the world. Whole world is envying you. Whole world wants to see that how do they derail our growth story. And that derailment of growth story is possible only if we are deprived of the capital. And if we are, how do you deprive the capital? Create such regulations. The BEPS have been created in the world, G20, no doubt we have participated. But what suits you, you take it. Why do you copy things which are not required to be copied by us? There are a number of countries which have not followed all the BEPS Action 15. Now we want to follow this. As a result, you can see for yourself, if the free flow of fund is coming to this country with a very low interest rate, that will stop. A lot of foreign companies have ability to raise money abroad at a very low or significantly low interest. And if that is funded here, you want to apply thin capitalization. And at the initial stage in infrastructure development, companies require money. In what form the money comes is not relevant. Let the infrastructure of this country develop. At least infrastructure, if not industry. Rest of the industrial development will automatically follow if there is a good infrastructure. And this is what the Chinese model, if we have to follow, you must follow that model seriously. This is so far general statements are concerned. Very easy to make all these a statement which appeals the public at large. But let's go. Our job is not to make a political statement. Our job is to understand the law and its impact as they have been drafted. I am quite sure by the time the budget will be put for approval, some changes are bound to take place, and some of the changes I could see myself. New section 92CE to provide secondary adjustment in certain cases in order to align the TP regulations with the OECD TP regulations have been introduced, and the reasons given are these are the best practices. I believe this is the worst practice. What is best practice? UK, example of UK. They want to introduce secondary adjustment. They want to introduce secondary adjustment. A draft consultation paper was put up on the website and circulated to the public in May 16. And that comments have been invited from people. 16 to 20 questions which have been raised. Is it in the interest of the country? Is it required to be done? All those questions one has to look at. I have given a source of that paper as well. And they said based on this consultation process, we will bring the regulation in April 2017 in this year's budget. Then I can understand this is the best practice. The best practice is you must tell the public at large in how many cases which have been done by the Income Tax Department in India, the secondary and thin capitalization which we are introducing, how many cases have been sustained the TP adjustment in the higher forums? the budget speech gives the statistics of the taxpayers, number of taxpayers in this country people have. Handful of the taxpayers. We have said 96% of the companies don't even pay the tax, don't even file the return. And we are now talking, we want to make the life difficult for people who are filing the return. What is thin capitalization? If the total income increases as a result of primary adjustment, secondary adjustment. If the total income increases as a result of primary adjustment, first of all, therefore, what is primary adjustment? Primary adjustment is that adjustment which is made because of the transfer pricing not having been accepted by the income tax department. Your payment or your transaction with the related party is not considered to be at arm's length. And if your transaction is not considered at arm's length, it is bound to result into a primary adjustment. So therefore, as a result of primary adjustment, the excess money available with the AE will be treated as an advance. What happens? Suppose, let me give you a simple example. You have purchased the goods from your associated enterprise. Purchases are recorded in your books of accounts at value X. The officer takes a view, the half X is the value. Then it means remaining half X is an excess payment made by you. So that money remains with the associated enterprise because you have made the payment to that enterprise. And because you have made the payment, the money has gone out of the country, and that therefore the rule says now it will be treated as an advance to that associated enterprise. The excess amount which you have already paid because of the transfer pricing adjustment made in your return of income, that excess payment will be treated as an advance to the subsidiary or advance to your foreign enterprise, associated enterprise, subsidiary or holding doesn't matter, or step-down subsidiary or sister subsidiary does not matter. That will be an advance, and if this is treated as an advance, then consequences are bound to follow. What is the consequence? This advance paid by you, deemed to be paid by you or constructively paid by you to your associated enterprise must bear some income, some interest from in my country. I must compute an interest on such an advance, and that advance, interest on such an advance deemed or a notional advance is secondary adjustment. So therefore, the definitions have been given in the law. What is primary adjustment and what is secondary adjustment? What I have explained you just literally if you read it. Primary adjustment says, to a transfer price means determination of transfer price in accordance with arm's length principles resulting in increase in the total income or reduction in the loss as the case may be of the assessee. Now, these are the increase in the income or decrease in the loss. Both will result into some adjustment in your company's hands in India. And that adjustment made in your hand is nothing but an advance. Paid to. Second example, let me give you a second example. You sold goods to your associated enterprise at X. The transfer pricing officer takes a view that the amount which you have charged to your associated enterprise is X, not correctly done. It should have been X plus 25%. So the 25% amount, the difference between that X and 25% is the transfer pricing adjustment. You are undercharged, so therefore there is an adjustment to your profit. And that amount we have not recovered. You already you are not recovered from the foreign parent, foreign associated enterprise. That amount has remained with it, and they are charged. You have charged less amount to them. You must recover that money. And if you do not recover that money, it will be deemed to be an advance by you to them. Every type of transaction this is bound to happen. So therefore it is going to result into some different consequences. Another simple example which is going to be a major issue in this country. Our tribunals have been taking a view, guarantee transaction is not an international transaction. Right? And the officer says no, guarantee is a transaction which is international transaction. You have a subsidiary abroad, they wanted to borrow money somewhere from the bank, and you don't want to provide the money, so you give guarantee. Now that on the basis of your guarantee, they borrow the money. On this guarantee, you ought to charge some commission. We say we are not charging, it is not an international transaction, that is under dispute. Having not charged the guarantee commission, the transfer pricing officer makes an addition to your return of income, and he says this is a primary adjustment, and then you have not recovered this money, so therefore there is a secondary adjustment. The question is how long and how many years I should go on making secondary adjustment is an issue by itself. Of course, some of the things are still to be clarified in the rules. They will say at what rate of exchange you will recover, how many years will be permitted to you. These are the best practices. Internationally, these are rules which exist. If you look at the EU paper, if you look at the OECD paper, if you look at the World Bank paper on secondary adjustment, enough literature is available in the world. And there is a complete guidance is available. Instead of circulating the paper to the public at large and inviting comments on that subject, the government just imposed the law on the public, and then when we criticize the people, they don't like it. This is one area where I have a reason to say it is not a best practice to follow this. And at least to say, again, in the memorandum explaining the provision says, with a view to align with the G20 and OECD's rules and as a best practice. What do you mean by best practice? Don't say at least. Don't make a joke of that word best practice. And therefore this is one objectionable area. So, if the guarantee commission is not recovered, secondary adjustment, how many years till you recover? Sir, 10 years I have not recovered. Go on making an adjustment. Now next year, I have not recovered guarantee commission, I have not recovered even the secondary adjustment amount. So in the second year, I will make further assumption that secondary adjustment amount is also recoverable from you, and on that also you have not recovered, that amount also you have not recovered. So secondary adjustment, so cumulative secondary adjustment. So this will go on, and that is going to create huge difficulties in real life scenario, which I will take you through. These are the simple difficulties, and there are complications which are going to arise. I am going to deal with them. And therefore, secondary adjustment, if you look at the meaning, means an adjustment in the books of accounts of the assessee and its associated enterprise to reflect the actual allocation of profit between the assessee and its associated enterprise. I can understand, if you look at this definition literally, it means where you have agreed for a suo adjustment, then only it is possible that allocation of profit between you and the associated enterprise can be identified and both can make an adjustment. But how do you compel if the other enterprises, the tax office in the other country says your transaction is at arm's length? You don't need to. For example, the rate of profit our country estimates on a safe harbor is 20%, 30%, all artificially inflated rate of profit, assumed profit. The other country thinks that 3% is the correct profit, 5% is the best profit. Why should they make an adjustment? They will not make any corresponding adjustment. They will not agree to do any adjustment and no allocation takes place. So unilaterally, how do you define, how do you comply with the definition? Then in that case, this is not a secondary adjustment. It is a unilateral adjustment made by the taxpayer in one particular country, and that could be an issue by itself. Allocation of profit between the assessee and its associated enterprises are consistent with the transfer price determined as a result of primary adjustment. Now, determination of transfer pricing is a function of both the authorities in both the countries independently. You have justified transfer pricing in a particular country on a one particular method, which is very popular here. Whereas in the other country, comparable examples are available, and you follow another method, which is cup method. Here, TNM method. Possible to do that. So, in such a situation, how do you resolve this problem, and how do you resolve this imbalance of the cash between actual profit and the secondary adjustment? There is going to be some great difficulties, and therefore I think this requires serious debate, and before implementing the law, the debate ought to have taken place. What the law says, if the secondary adjustment will not be made if the primary adjustment does not exceed 1 crore rupees. and if the primary adjustment is made for the assessment year up to 16-17. The word "and" is there. I am going to highlight this important amendment. Such a interesting. If this is the amendment, I welcome this. There is no problem because it applies to only up to assessment year 16-17 and not from the subsequent year. 17-18 there is no law. Anyway, it is not applicable. And the law which they have said it will apply from assessment year 18-19. But if the language of this section, if you read it, the word is "and." What the section says, if the primary adjustment does not exceed rupees 1 crore, and if the primary adjustment is made for any assessment year up to or on or before 31st March 2016, assessment year 16-17. So therefore, "and" word gives a complete misnomer under subsection 1 for first proviso. And therefore, I believe if this is the way the law is drafted, is welcome. The law possibly, as I said, at the time of amendment, they may change the word "and" to "or", and that will have implication from assessment year 18-19, the way it has been drafted. Secondary adjustment is possible only if 5 conditions are fulfilled. You accept the addition in the primary adjustment, suo motu. You make yourself an adjustment in the return of income and pay the tax. Then secondary is bound to be invited. Or assessing officer, while making an assessment, makes a primary adjustment and you accept that. You don't file an appeal. Then secondary adjustment is bound to be there. Or you go to advanced pricing authority and you agree for an adjustment at a particular rate you arrive at, because this is the way in which they have looked into the transaction by the time return has been filed, and therefore you then make an upward adjustment in your transfer pricing figures and offer it to tax. Secondary adjustment 100% is bound to be there. Or you have accepted the dispute under the mutual agreement procedure, and then you have said this adjustment is acceptable by the whatever the taxpayer, the tax department has done, that you have accepted, then that secondary adjustment is bound to happen. These are the 4 situations, and 5th situation is also provided where it is suo motu. So therefore, if you dispute the primary adjustment, no secondary adjustments can be done on its own till the matters are resolved. Now, till the matters are resolved, whether secondary adjustment can be done by itself is an issue by itself. If you look at the language, there are a number of problems. Now, if the primary adjustment has been made in the assessing by the assessing officer, first of all, if the best practice has to be followed, the government of India should give us the figure as to in how many assessments we have completed 15 cycles of the transfer pricing so far. So, in how many years and how many cases people have filed a return by making a self-adjustment? In how many years at the time of assessment the taxpayer has accepted the addition